If the value add is done right and the rents are going to increase and the operating expenses are going to be managed more professionally, that is far and away going to exceed any fluctuation in interest rates.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupey as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
All right, everybody. Today, we're going to talk about active versus passive investments. A lot of people don't realize that you don't have to do all the work yourself. You don't have to just buy a single family house or an Airbnb and self-manage. You don't have to actually invest in your own backyard. I know that's something that a lot of people struggle with. And can tell you a little bit of backstory here. I started in Rochester, New York, right after college, bought a number of single family and two family houses, and did all the work myself. At some point, we had some maintenance people and some property managers, but it was very much the way a lot of people get started. And then in 2008, joined a firm and eventually started my own buying distressed loans. And all of a sudden we were getting hundreds of properties dumped on us all over the country, and realized that there's a good amount of support between great realtors, property managers, especially in the non-performing loan side. There's a lot of vendors that cater to banks. So you could really invest anywhere. And we were able to successfully liquidate thousands of foreclosures all over the country. So if I could do it that way, investing in a syndication deal, a larger apartment building that has over 100 units where there's on-site management, a self-storage facility that in many cases can be run electronically or with part-time help. It's much easier to invest outside of your own area, especially if you're investing in larger, sophisticated syndication deals. So if you're comfortable investing outside the area, what's the next concern? A lot of people are just worried about how to underwrite, how not to get scammed, how to pick a good operating partner. And I went through all of this myself over a number of years. So when I was in, and I've told this story a few times, but I was in New York City, a partner in a large distressed debt firm. We had almost 30,000 mortgages and was doing great, making great money, but paying a 50% tax rate. So I started looking for opportunities to have more tax efficient investing, and started down the path of looking for syndication deals and talking with various operating partners and sponsors and vetting them and going to events to meet those that were syndicating and running funds and buying multifamily and self-storage, and got very comfortable and tested a number of partners with my own money, and many of those are those that we're still working with today a number of years later with JCAM. And you're giving up having direct control of over the deal, but ultimately what I found is these operating partners are actually doing a better job than I would do. I am not that micromanaging taskmaster who's just grinding every day and likes to be bad cop. I'm more of a networker and connector. That's my personality. And so, what I found is there are a lot of operators who are actually much better at that, and they want to focus on doing the operations, and they don't want to focus as much on marketing or recording podcasts and getting that message out there. So that's where really we plug in with JCAM Investments. Is we partner with best-in-class operators, and many of them are kind of under the radar, and love that we are out there and going to events and really getting the word out that investing passively is a great alternative to the traditional Wall Street roller coaster. And that's really one of my passions. I love tax efficiency, and I love helping people get better returns and just better optimize their financial and their lifestyle. So here's a few examples of recent deals. We had a deal in Phoenix that was bought in September 2020 and exited in the beginning of October 2021. And we actually doubled our money in a year and 2 days, and worked out to a 97% IRR. It was literally a few dollars away from a double in 1 year. And that was a 286 unit apartment building where only 50 of the units were renovated at the time, but it was a great proof of concept. And the ultimate buyer, knew that the remaining 200 plus units, a majority of them had $300 to $400 a month of increased rent potential, and that by locking in a long-term fixed rate debt when they purchased from us, they had significant upside over time with minimal risk. And it turned out for them to be a good deal because they locked in with long-term fixed rate debt in late 2021 before rates moved up. So I don't know whether they got 7-year or 10-year debt, but either way, the rents are still increasing dramatically, and they're locked in for long term. We had another recent deal called the Lionsgate apartment, and that was sold in Q3 of 2022. So that's sold with rents. That's sold where interest rates had already moved up significantly. And that was purchased in late 2020 as well. And rents were up about 20% across the board from renovating units. And it's sold to a local family office, again, a group that is buying to hold for a longer period of time. And that yielded a 36% IRR in little less than 2 years. So it's really, I think, a great point that even with rates moving, properties are still selling with significantly strong returns, provided that the value add is done, that rents are going up, that the renovations are happening. One of the other cool things we've done recently is we have a relationship with a fund called Polaris. And they typically have a higher minimum. It's usually a minimum of 250,000. But through our direct portal, we have a number of opportunities where, for our investors that want to invest in individual deals, we have opportunities to invest in individual syndications as well as lending funds. So this is a hard money lending fund, and it pays monthly cash flow. And when you compare it to treasuries or stocks and bonds, it's a significantly higher return, and it has liquidity. So unlike a CD or something where you're locked in for a period of time, you can request a 30-day notice and request a withdrawal of funds. So it's been a great place for some of our investors to park some funds. And one last deal we'll highlight is one of our earlier acquisitions in Jacksonville and St. John's Point. We love the Jacksonville market. We've made a number of strategic investments in Jacksonville. It has a great growing population. It has a bit of a military presence, but there's just a lot of workforce housing. There's a shortage of workforce housing, and there's a lot of job growth there, and that's just various diverse industries in Jacksonville, and it's a great overall market. Unlike a lot of groups that were going in with bridge debt, with very aggressive high loan to values, with as I said, bridge debt, but bridge debt that had a floating interest rate. This deal, as well as a number of the deals with our same partner, started all with Fannie Mae debt, long-term Fannie Mae debt with either a 5-year or 7-year fixed rate. And the rents are up significantly because, with all the inflation and all the noise you've heard, inflation is causing wage growth, which is causing rent growth, and there's a shortage of affordable housing in the market. So what that's resulted in is the annualized cash flow is up over 11% at this point. And it's much higher than the initial pro forma, and it's turned into a great cash cow of an asset because our interest rate is fixed, and the revenue just keeps growing to adjust with inflation, and our debt service is fixed. So it's three great examples of successes, and these are all three different areas of the country. Well, four different areas of the country if you factor in the lending fund is actually in well more than four areas, but three different strategies, and great results all around. And these are all without having to take a phone call from a tenant and or deal with Airbnb. And lastly, there are significant tax benefits here. If you owned a single family house, you might get 5, 10, 15, 20% depreciation per dollar invested. However, these larger syndication deals, it's not uncommon to get 70, 80, 90% of your per dollar invested as a tax loss on paper. So this can offset other income that you may have that's passive, or if you have no other passive income, you could carry forward a loss, and that loss can be, will offset any future year distributions from the syndication, or even proceeds if one building sells, but you have enough of a loss from other syndicated funds. You can, in many cases, show almost a perpetual loss if you structure it right. So I want to talk a little bit about how this works operationally. So JCAM, we're vetting sponsors daily. I'm preaching passive investing, but ultimately the early stage and the vetting, that's the most active part. We've got probably 50 plus sponsors in our database, and we've invested with over 15 different individual groups. And each of these groups is generally looking at thousands of deals. At a minimum, most of our multifamily partners are looking at 200 deals a year, and they may buy 2 or 3. So of those 15 groups that I mentioned that we've already invested with, if they're each looking at 200 deals and they buy 3 a year, that's 36 deals a year. And we may do 12 to 15 deals a year. So of the 200, that yields 36, and we're picking the best 12 at most. So we're really getting the best of the best opportunities. And, in addition to our current sponsors, we're members of a number of mastermind groups. So, as we meet new sponsors, we're very rarely meeting a stranger. We're meeting a sponsor that is in another professional organization with us that has a lot of references, including some of our current investors who may have also invested successfully with them. So, it really is a private club, if you will. And we've been very successful, and there's been a lot of work put into that. I posted something on LinkedIn a few weeks ago that I had 140 nights in hotel rooms last year because we're constantly going to industry events. We're constantly traveling to see properties, to meet partners and sponsors, and it really takes up a lot of time in the initial meeting and vetting sponsors. We use CoStar to do our own underwriting, and there's so many levels you can go with underwriting deals, and looking at models for what happens with interest rates, what happens with inflation, what happens with rents. The one thing that I will continue to preach is that to me, the largest factor is on a value add deal is what are the current rents and what are the rents going to be after renovation. That doesn't account for what do we think may happen with inflation and just rental appreciation. All that stuff is out of our control. What's in control is, do we believe the business plan of a unit that has new kitchens and new bathrooms? Will the rents go up $300 or $400 a month on the renovation? And that's much easier to decide. And that's something for years we were doing that on individual single family homes that were thrown into our lap because we unfortunately had to foreclose and take them back. So, we're looking at single family houses in any market in the country and pulling up the comparables and trying to decide, is it worth renovating or do we just sell as is? So for these multifamily apartment complexes, in a way, it's easier because we have access to tools like CoStar. We can see the other apartment buildings. We can see what the interior condition of them, what the square footage is, and we could really compare, is our 1,000 square foot unit that currently rents for $1,000 going to rent for $1,250 after renovation? And what is the competitor? What are they renting for down the street? Does that comp down the street have better curb appeal? Does our building have better curb appeal? So it's a much more exact science than being in the mortgage industry, where you just have a mystery dumped upon you and you've never been inside and you have to get in and figure it out. So overall, the value add is the number one component. While we're certainly tracking interest rates as I record this today, the Fed's going to make an announcement at 2 p.m. Eastern on whether rates go up. The consensus is that it'll go up 25 basis points. And that all gets priced into the model, and where the acquisition is and where the potential exit cap rate will be. But overall, our thesis is, if the value add is done right and the rents are going to increase and the operating expenses are going to be managed more professionally, that is far and away going to exceed any fluctuation in interest rates. If interest rates are 0.5 point higher than we think they may be in 3 years, the amount of value we're creating through the renovations and the value add is just so much significantly higher than 0.5 point in interest rates, or 0.5 point in where the cap rate is in 3 to 5 years. And one other point just to point out is we have a fully remote team. We have team members in various parts of the country, and we're in over 15 different markets at this point. And each of our key operating partners tends to focus on 1 or 2 markets. And with that, we've got really good coverage to pick the best of the best in the Southeast and the Sun Belt, which are our primary locations. But we've also dabbled in deals in the Midwest. We're in a cash flowing deal in Dayton, Ohio that just immediate, strong, high single digit cash flow with the likelihood of growing into a double digit cash flow. And that's a slow and steady market. It's not a market I worry about crashing or adjusting. We have a few deals in Indianapolis, which is a solid Midwest market, as well as a ground up self-storage deal in Kansas City. So overall, there's a lot of opportunity in the syndication space. And, a lot of investors over the last couple of years were kind of addicted to the easy money of the stock market, or, the tech bubble, or they're screwing around with crypto, or they're buying something they want to do in Airbnb, and, often creating themselves a job. It's hard work to own and manage properties. It's if you're not at scale, it's very, very difficult to outsource efficiently, and it's very difficult to find reliable help. Contractors often are not going to show up if you only have one property, or they're going to give you a retail type price. Whereas if you're renovating hundreds of units, they'll be knocking down your door to bid that project, because it could be months of steady work for them. So we encourage everyone to continue to educate yourself on private real estate funds and syndications, because I do think, and I think it's been proven, that the opportunities and the returns are significantly better than what you can do on your own, and certainly provide more reliable and higher returns than the traditional Wall Street roller coaster. So that's it for this episode. Please follow us. Give a review for the podcast on your podcast platform of choice, whether it's iTunes or Spotify. Like and subscribe to our YouTube channel for JCAM Investments. And we're also on LinkedIn, Facebook, and Instagram. So please connect with me personally, Jack Krupey, and our company page, JCAM Investments. And look forward to seeing you on the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there, all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.